Howdy, it's Mike again. We are going to have pretty productive and hopefully short video today because I know the last one was on the long side, the one that I did on my journey and goals. So I wanted to keep this one short. I think I'm going to do it this time. We'll see. Um, the focus is going to be on ways of exiting a failed breakout, the rules that I developed, and so we're going to walk through that rules, guidelines, whatever you want to call them. I'm just going to call them, Webby breakout failure rules or something like that. By the time I release this, I'll try to think of a better name. But, anyways, there was a problem that I was trying to address, and that was how to cut your loss when a breakout is failing. And this will, I'll walk you through, all of that and what those rules are and what the guidelines are and the pros and cons of it. And this is more for position trading than swing trading. Swing trading, those rules are, quite a bit tighter, but this is more for your kind of standard position trading. But before we get into that, I just did want to just kind of share the channel, for anyone who's new to it. And I did make some recent changes to kind of the layout in. Let me just kind of move this over so that I was thinking with all the episodes that we were having that the layout wasn't that helpful. So I decided to put some things in some playlists here. So this is on my YouTube channel, Webby 51 50. And let's go into the playlist here. So if you just want to look at all of them, just do the podcast one down here. So this is the Webby Rambles on full list of all of them there over there. But each one of these is going to have one. So here, this one, the other ones only has one in there right now, and that is, how I use market surge, and so that's a that'll get bigger. Then non-stock related ones, which are just basically those two, the fear one as well as the ones that I released this morning. I'm actually recording this on May 31st to have it ready for next weekend. And so those two, I know no one really wants to watch them, but let me tell you, I think those are the best ones, frankly. Then where most people want to start is the general market series. And so this playlist, has all of them from, the original precedent analysis one, 21-day follow throughs, and all of that good stuff. The power trend, definitely. We're in a power trend right now still. So you want to watch that so you understand what that's all about. The model book series, this is where if I was watching these, this is where I would go because this is really where you learn everything. And so I'm going to do a ton more of these. I would start off with how to build a model book, which is number 2, and then do the rest of them in any order, whatever one is interesting to you. Just do that one first. But I would watch all of those. That's how Bill learned. Bill O'Neill, founder of IBD, my mentor, learned everything, and that's how I learned everything. Is just studying models and building models. Then the Webby inventions. I love this, and that's where this one will go because this is one of my inventions. It's a strategy of exiting a breakout that appears to be failing, and everything from how and why I developed the composite rating, how and why I developed the growth 250, the IPO base, my 21-day stuff, all those things, anything that I created. The most important one on here, I would say, would be the quicksand Grateful Dead, which is number 20. And I think that's the best thing I've been able to come up with so far. So I'm going to try to outdo that. But that's the, oops. Let me see. Let me go back to it. Yeah, that's pretty much. Oh, there was one other thing I wanted to show. This is my fun part. So this playlist here, the non WRO music and other cool stuff playlist. I'm just anything that I always liked. I used to put it in a playlist for myself or things that I wanted to watch. I put it in a playlist for myself to view later. And instead of doing that, I'm doing it here. So some of these things I still need to watch, or I think it really cool, and I think you guys would like it. And just lots of great stuff. I mean, here's Jimmy Page doing, the Kashmir stuff on It Might Get Loud, or BB King and Sing Sing Prison, or Stevie Ray. There's all that stuff. There's music in there, but there's also podcasts like this one. If anyone's interested in learning about what alcohol does to you, you got stuff like that in there. Or if I'm on a podcast, I'll put it in there, or just any interview. So check that out when you have time. Or wow, this Justin Johnson with his stuff, I got a bunch of his stuff in there. Just great stuff. Or look at this Marcus King when he was just a baby, just a tiny little baby right there. So we're going to stop sharing that, but I think you guys will have a lot of fun with that stuff. I would just, if you just need some background music or something to watch while during the trading day, that's what I do. Either Spotify or YouTube, just for some background. But anyways, what we are going to talk about today is selling rules. Or why I should do this, because I never know when someone's new to the channel. I'll try to be brief with this. This channel is for two reasons. One is for you. I wanted to have something that was free, so anyone could watch it. You could be a billionaire, you could be, a junior high kid who's just wanting to learn how to trade, or anything in between. And I wanted to have something where everyone could access it for free. I should be charging for these. Obviously, if I charge for them, I'd have to cut out all the all my rambles and just focus in on, so a 3-hour episode will go down to 10 minutes. But one, I'm not going to do that. Two, because the second reason why I'm having these is, I realized some things have happened in life where I realized life is very short, and I wanted to have something for my kids if they ever got interested in trading. They're 23 right now, and twins, and they're each starting their own careers that are totally different, and just really don't have any interest nor time to learn how to trade. And I never taught them how to trade. And I just thought, if there was ever a time where, maybe they're in their 30s or 40s or 50s that they want to learn how to trade, if I'm not around, I wanted to be able to teach them. So this series was really for them. I was going to just record it at home and just keep them for myself and give them to them. But I really thought, logically, that I would do all of this work and they would get lost. So I figured if I put this up on YouTube, the likelihood of YouTube being around, or some version of YouTube being around 10, 23, however many years from now, that they would still be there. And really, if my kids never have any interest in trading, which is totally fine with me, maybe their kids, when my grandkids that I don't have yet, will end up being interested in it. And I wanted to leave this. I spent my lifetime learning my adult life, learning this skill set. And I just wanted to pass along to them. I mean, some people pass on other things. This is what, I wanted to pass on to them. So it's for those two reasons. So when you hear me rambling on about stuff, you're gonna like, why is he telling that story? It has nothing to do with anything. During these, I just let my mind wander to wherever, because I wanted to have some documentation of some of these stories to for my kids and grandkids, and I'm hoping that some of them, maybe 10% of them, are of value to you as well, or entertaining, or you learn something from it. So please put up with those. I mean, these are free, man. So that's your, that's what you kind of have to put up with. So I appreciate that, and I appreciate all the kind comments and everything that have been made about this channel. Man, it just really warms my heart. I read every single one. I'm been saying this for many episodes. I'm just behind in getting back to everyone. I just need some downtime, man. I am swamped. Let me just tell you, I'm swamped when I'm committed to putting these out. So I know I'm gonna be tied up for a couple of weeks. So I wanted to record some of these, have them in the can before life got just too busy for me. So with that said, for the old schoolers, what I'm I'm doing. It's 10 minutes in, and I'm actually going to get into the meat of stuff. Look at me, man. Gold star, Mike. Gold star for you. So we are going to talk about cutting losses. And this is something that I developed, and I backed into this over a number of years, and deep thought, as well as just looking at a ton of charts, is I wanted an exit strategy. And this is for, again, this is for position trading. You can modify it for swing trading. But just so if you don't know the difference between the two, swing trading is short-term trades. They could be a couple days to a couple weeks. Position trading is what people normally think of when they think of, Bill O'Neill or IBD, or this philosophy is really holding, weeks to months. And so it's a little bit different. So when you're going to hold weeks to months, your gains are going to be, potentially going to be larger. That's a concept than swing trade, which are going to be shorter. But there's a whole compounding effect there. So I do a combination of both swing trading and position trading. It really depends on what's working at the time, where I focus more of my time and energy, or really what merchandise is out there. If I come across like an A quality, what I deem as an A quality stock, I want to do that for position trading and hold it for a longer move. If it's just a trade, or frankly, it's a low quality, piece of junk that I'm just trading, well, I just want to swing trade that. I don't want to hold that for a long period of time and risk being in a gap down. So with that as a backdrop, today's episode is focused on position trading, and when a breakout is failing, how to get out. So remember, if you know anything about Bill's philosophy, he was to cutting your losses at a maximum 7 or 8%. So for today, I don't like saying 7 or 8. I'm going to just say 7, because most of the time he would go with 7, but sometimes he would say 8. So we're going to go with 7%. So I knew that the max loss that he would say would be 7%. And the reality is, no one ever talks about this, but I'm just going to put it out there. He came up with that 7% is because he studied the models, and he said, well, and you got to remember, the model books were originally actually books, where he started off with just the chart of the stock in its whole move. And then eventually he switched into the chart at the beginning of the move, what it looked like, and then after it had its advance. And so on the left side of the book, it would be at the beginning of the move, on the breakout week or the week before. And then the other one would be after it's already had its move. And there's a reason to study both of those. In fact, then later on, when I built books with Charles, we did some where we would break it up and have some kind of midway through as well, because there's certainly an advantage to that, because when a stock has a big move, the earlier move and the middle of the move, those charts get compressed, and so you don't see the wiggles and wobbles the way that you would have seen it in real time. And so it's important to look at it and do like kind of change dates. And so that's kind of a big topic, but really it's starting it off at the beginning and at the end. And where he started off at the beginning was not a computer doing it. He was picking it. And then when I started, my first model book that I worked on was in 2000, and that was for the 97 to really to 2000 timeframe. And I did that with Ross Haber, great guy, one wonderful human being. I shared an office with him for a while. That was fun. Well, in fact, I'll tell this story now. Here I'm going off on tangents, but it is what it is. So when I first started trading, so this was in early 2000, when I got money to run from Bill. So my first trade was January 13th of 2000. And there wasn't a lot of space around the office, because Bill, if you'd ever been into the office, it did not look like a billionaire ran the place, man. This place was in our nicest room. So our institute, so upstairs was William O'Neill and Company, the second floor, and the first floor was IBD and Daily Graphs, which is now Market Surge. And so upstairs in our nicest office, and this was the office where clients would come in. So, the hedge funds, mutual funds and stuff, when they would come out to meet with anyone, sales reps or whoever, there was broken chairs. There was literally duct tape on the floor holding some of the carpet down. And I love that because that was Bill, man. He did not care about fancy stuff or anything. Like, it was just, is nice carpet going to make us pick better stocks type of concept? And the answer was no, so he just didn't care. So I don't think we had to do the extreme that he did, but that was just how he was wired, and it didn't bother me. But, well, sometimes it bothered me because when it really impacted me, it bothered me. So one of the ways that it impacted me was, man, he did not believe in big fancy offices. So I was put in this office that was so small that it was technically illegal to put someone in there. And I ended up being in there with Ross. So two people in an office that was too small. I was actually told that if Cal OSHA, I think it was Cal OSHA, if they come, and I thought they were joking when they told me this, that if they were to come in to do like a routine inspection or whatever, that I'm officially working in some other area, some cubicle or something. But because back in the day, we would PMs would place trades with our desk. You wouldn't enter them. You'd call up. For compliance reasons, we couldn't be out in the open. We had to have an office. So if it was up to Bill, we really would have just had a cubicle, but it was really more of a compliance thing. They just said, if we're in there doing trades, someone might overhear it. And then there's front running and all this stuff that could happen. So we were very clean shop. I mean, really clean, which I loved, because you never had to worry about anything. So I was in this office that was so small. Just to give you an idea of how small it was, for the rest of my life, I'll always remember how wide it was, because I could go like this with my arms and just lean this much, that much. And that's exactly how wide the walls were, because I'm claustrophobic. And so would be in there and I'd stand up and I would do this. I'd just go back and forth and I hit the wall. But I was just so happy to be a PM. It didn't bother me. But I was in there with Ross for several months, and man, what a blast we had in the top in March of 2000 when the market topped. We were both in there together, and I remember we were calling up, just placing order after order, just to, I wouldn't listen to what he was doing. He wouldn't listen to me, what I was doing, because it would just mess you up. So you're just in your zone and you're kind of like tuning things out. But we were both just, Bill didn't tell us, hey, the market's topped. We all just, everyone on the team, not just me, not just Ross, everyone just, we were just selling everything, the top, I know it was like March 10th or March 14th or something like that of 2000. But that was actually an easy top, frankly. It was what happened after that was tricky, but the top was easy. But anyways, I built my first model book with Ross and then with Charles Harris, and the rest of the model books I always worked with him on, with Chuck. And when we would do it, it would be a long process. And I talk about that in number 2, WRO number 2, how to build a model book. And essentially you screen through, find all the stocks that had big moves, and then you would, do some weeding out once you realize what Bill would like. And then you present them to him with where you thought the pivot would be. And what you realize right away is the true pivot and the pivot that he would want to choose were two different things. This becomes very important. If the stock broke out and then shook out below that pivot more than 7%, he would say that wasn't the pivot. Because he always wanted to say, well, if a stock breaks out, it's not going to go down more than 7% from the pivot. Well, no, that's not true, man. I'm sorry, man. Look at the charts. If you go and you pick a point at which it never goes down more than, pick any percent, 1%, 5%, 10%, 30%, whatever, and goes up, well, then you're not going to have any that fall into that other camp, right? Like, let's say you want to build a model book where the stock never goes below that point. Well, you trace back to the very beginning of the move and you say, okay, well, it never went below that point, and those are the only ones in there. That doesn't mean that when you buy a stock, it can never go a penny below what you paid for and still work out. Like, there's just a disconnect there. And so that always bothered me because, and Bill didn't see it that way. He just was really, he wasn't trying to do anything. That's just how he looked at it. We just looked at things differently. One's not right, one's not wrong. It's just different. And I'm more of a, well, I'm just different. Let's just put it that way. I don't want to put labels on it. So that bothered me, knowing that you could pick the right stock and it could go down more than 7%. And you just have to be willing to, if it sets back up, buy it back. And that sent me on this journey of trying to figure out the right stop loss to put in. And so I knew that the max loss that we were going to be able to take was 7%, but I also knew that Bill liked keeping his average loss around between 3 and 4%. So let's call it 3.5%. So if his average loss was 7%, and or average loss was 3.5%, and 7% was the maximum, that means that he was cutting a lot of his losses well before even 3%. Just do the math on there. If some of them are hitting 7%, and he would always say he would like to be gone before it goes down 7%. Now, obviously, now these days you have a lot more gap downs and things, so you've got to bring that part into it. But if 7% is your maximum, but your target is 3.5%, well, you need to figure out some rules in there, and that's what these rules are that I'm going to go over. Of where do you cut those losses? And so I wanted to use the chart as my guide, because even though I came up with this before, I was using ATRs, average true ranges, as a big part of what I do. I was just looking at it saying, okay, well, 7% is here, 3.5% is here. So we want to try to target it here, but we know we can't go beyond this. So you just need to, if you have a problem that you're trying to solve, you want to know what your maximum levels are, right? So your maximum loss is 7%, and you also want to know what you're targeting. So you're targeting 3.5 or less. So how do you do that and have it make sense on a chart? Now that I would probably, if I was trying to approach this fresh, I would focus more on ATRs, but that's a topic for another day. This is going to be more my original way of looking at things. And probably this is about time to look at some charts, because it'll make more sense as I go through this. So let's see. We'll pull up market surge, and just make sure that's there. So I flagged some stocks in here that I was going through my normal screening, and I'm like, oh, this might be a stock that would be worthwhile. So this is in no particular order. I just have this in alpha. So let's just look at these and it literally just flag these. So let's hope that we can remember why I did that. Let's see. So hold on. Okay, I was just acting funny. Okay, so it must have been over here that I was looking at this breakout failure. So again, what we're trying to do is say, and for today, we're going to focus more on the standard pivot, but this works for alternative pivots as well. So this just happens to be Bank of America, and we're going to be looking at on 2/6, February 6th, that breakout that ends up failing. Well, you know that it fails now, goes from 47 to 33, but we want to see how to get out of it. So let's start off by let's just do. We know that for sure on 220 we would want to be out long before that, but that would certainly be the time that you would want to be out. So let's go there. All right, so the handy thing with pattern rec, which if you watched, what was that, episode 21, I think, or 20, one of those, you'll, I would certainly suggest that. Let me blow this up even more. Okay, so that's too much. Okay, so here's the cup with handle. Here's our base that is forming. And, that's a pretty good base. We know that it didn't work out, but on 2-3, this would really be your ideal entry from a swing trading standpoint, because you've got a cup with handle, shake out below your lows, getting support back at your 21 day, and then buying it here using a stop loss right there. As from a swing trading standpoint, that's what you do, but that's not what we're doing. During this, we're looking at kind of position trading, and this would be, you could look at that as an alternative buy point as well, but for now, we're going to just focus on standard buy points. So here's your standard buy point. So what information do we know? So with this shaded area here, we know that we want to be out before. I think I set this to 5 to 8% versus your pivot, this area. And this is 0 to 5% is the blue shaded area. So you're buying it for today. We're just buying it on the standard pivot. We might, if we find some other alternative pivots that are still easy to understand, I'll do that. So now this is where my rules come in. So if you haven't listened to a word I said, it's only 25 minutes in, that's not too bad. We are going to focus in on what I call day one, which is the pivot day, and day zero, which is the day before the pivot day. So here's day one, here's day zero. So the day before the breakout is day zero, the breakout is over here. And of course, you're probably thinking to yourself, well, what if this is day one? Like that's a different topic. Let's just keep it simple. So day one and day zero. So those become now our lines in the sand, because if you look at enough charts, a failed breakout is going to come underneath those, right? But just by definition, that's the breakout day. If it's failing, it will go underneath that. And if it's truly failing in a big way, it'll undercut the low from day zero, the day before. So now we have a reference point. And you'll see in some of these where that gets tricky, but this is more of a cookie cutter one. So now we want to break up our stops into, rather than just having one stop where let's say your stop was at 45 and you're looking at this, say, I'm going to let it go all the way down to 45, because you know what? Stocks break out, they wiggle and wobble a bit, and you really want it to be a broken chart before you exit. I have no problem with that. Just realize with that, the downside to that is you're going to be having a lot bigger of a loss when you do have them. Now, the upside to that is, and you'll see it, you doing it my style, you're going to get chopped up a bunch, because you're going to be in there backing away, then having to buy those shares back and doing all these transactions and all this work that, there are going to be times where that is going to chop you up more than just letting this come all the way down to that level. And frankly, technically, you could let it come all the way down into that level before selling it. Well, that would be silly, right? If that stock came all the way into that level, that would be really broken. So that's another problem I had with this 7% thing, because 7% on Bank of America, which is a relatively mild stock. Let's see if I've got the ATR in there. So its ATR is only 2.15, or at least its current one. So with that, oops, hit the wrong one. If it's normally trades, let's just call it 3%, just to be nice. It's 3%. So that would be, more than 2 ATRs, average true ranges off its high, for it to, for it to be down 7%. Versus if you have another stock that has an ATR of, let's say, 8% for the day, only one ATR, and you're already past your max 7% loss. So that's problematic. But we're going to work with what we have and try to keep this as simple as possible. So this is the low of day one and the low of day zero. And these are going to be our lines in the sand. Now, our next one is going to be our max losses. Where is our max loss? So we're going to just say, you know what, for this, we'll just use the bottom of the red area, or you could just, we'll do it up there. So that would be, no, we're going to keep it with 7%. I was just trying to make it simple, but I don't want to make it overly simple and be problematic. So 7% is still going to be our max, but let me just do the calculation on that. 4751 times 0.93, 4418, 4418. So right around there. Yeah, right around there. That would be your 7%. So that would be your max loss, your max 7% loss. So we have this line in the sand and we have this line in the sand, day 1 and day 0. So those are your warning signs. So we know that if it comes down to here, we have to sell everything. But we also know now that if you get a close below the low of day 1, that is your first sign that it might end up coming all the way down here. So you want to start backing away because, again, our goal was to try to keep our max loss at 3.5%, the way bills were, or smaller. And so you sell some there, and then the low of day 0, you sell some if you close below there. And then if we just want to make this the simplest, on the simplest level, sell a third here, and then you keep your last third for your 7%. And that's on the simplest level. Now, the reality is you want to make things as simple as possible, but sometimes there's loopholes and things, but that's your core, the core concept for Webby's breakout failure rules is the low of day 0, sell a third, the low of day 1, sell a third, low of day 0, sell a third, and then sell the rest when it gets down to 7%. So let's walk through this one, and you will see where some of these become tricky, and there's lots of gray. They're not always as simple. So let's go for this day. So now you've got an inside day. Yes, it's underneath your pivot of the 4751, but not in a material way. And it's an inside day, meaning it's trading within the high and the low of day 1. So we're on day 2 right now. So you take no action. And this is a very normal and healthy day 2. Then, okay, so now we've got a situation on our hands where it's failing. So we've got the low of day 1 is 47.17. You can see it there in the track price. And the low of day 0 is 46.64. And it closed at 46.67. But the reality is you'd be doing this in the last few minutes of the day. And so technically you only have to sell 1/3 of it there because it closed underneath the low of day 1. In day 0, it's like close 3 cents higher than that. But that could have gone either way. And I like to be intellectually honest. So if you said that you would sell the other third there, that's what I would have done, because you're making this decision in the last 10, 15 minutes if you're using the close as your guide. And so that, with the price fluctuating around and everything. But let's just use hindsight and say that you only sold a third because it was a close below there and it technically held up there. So let's see what happens the next day. Okay, so it holds up there. And there are other things that now that you're looking at it and saying, okay, legitimately it stopped there. And so that could be your line in the sand for really the rest of it, because remember the 7% was down here, and you look at this chart and go, well, by the time it came all the way in there, that would be a broken chart, and it would be breaking my expectations. But right now, this isn't a total break of an expectation. Lots of breakouts pull back into their pivot area. So let's see what happens next. Okay, so now we have our next sell, right? Because we get our first close below the low of day 0. So now we've sold 2/3. But the reality is that last third is a judgment call. If this was an A quality stock, I'd give it some more room. If this was anything less than an A quality stock, I'd be out of there because it did try to make a stand there and couldn't do it. But at minimum, you would only have, or the most you would have would be a third of your position left, because you have one sell signal, two sell signals. So let's just review that, or let's go out a couple more days and then we'll review. So see, it's dueling around, trying to come back. See when it gets down to 7%. It looks 6% from its pivot. Okay, so now it's 8% from its pivot. It's totally broken down. So looking back at that, just think of all those chances that you had before it got down to 7% to, warn you to get out. So we had our close below the low of day one, close below the low of day zero. This also closed below the low of your first supporting type of action. So really, you can legitimately say that you'd be completely out on this day, on the 12th. And that should be your goal there, and you're only 3% down from your pivot. So now you've got some sold at less than 3% because you sold some up over there. And then you've got the rest here. So this is very, very simple. Now let's go out just to the end of the month. So, it's trying to come back, and that happens all the time, but that's not a proper looking chart at that point. That's just a snapback type of rally. So I wouldn't buy it back there, even though it's breaking that line there, because this is really a broken chart that is bouncing, and I don't like buying them in that position. So if you are saying, hey, no, you want to wait until it's 8% down on everyone, hey, whatever works for you. This is not investment advice. I can't give investment advice because I'm not an investment advisor. This is just me trying to show you something that I learned and that I use for my position trades. Now, there's another thing that if you want to be tight and be kind of in between a position trade and in a swing trade, what you can do is just say, you know what, you're not going to use the 7%. You're going to just use this day one and day zero, saying, okay, day one, a close below that, you're going to sell half of it. And a close below the low of day zero, you're going to sell the other half. There's nothing wrong with that either. And that would be more in line with how I really trade, because at that point you have enough evidence. But this, I just wanted to have how I originally had it. And then, there's modifications on this, tons of modifications that you can make. And let's see how this ended up playing out. Let's go reset to today. What did that do? Okay, so this is where we were looking at it, and that first sell there is looking pretty good, right? And of course, we had that bear market, so almost everything fell apart. So that was that stock. Let's look at another one because there's all sorts of variations. We'll just do this in alpha, so there's no bias on here. So we're going to look at this breakout failure. So let's go back. February 7th. So probably a lot of them are going to be in that same time frame because the bear market. Because most things follow what the market's doing. So again, this was really your ideal day on the 3rd, that upside reversal. That's where I like to buy them, because when you have a shakeout in the handle, really there's nothing better, because now you have something that it should just move up from there if the market's ready and the stock is ready. But let's go out and see. And certainly on this day, you could consider that an alternative pivot, went above that area. So there's alternative pivots in here, but we're, again, just focusing on the standard pivot. Okay, so here's our standard pivot on the 10th. So this becomes day one, that's our low. And here is day zero. So we're going to sell a third if it goes below that, sell the rest there. And then we know that 7% is somewhere in this area. And that's our final line in the sand. So let's go out a day. Okay, so right away, we get a close below the low of day one for sure. So we're selling a third. And let's see what's the low here. The low is 118.49, and it closes at 118.06. So now you've sold at least 2/3. And again, you can say that you can sell the whole thing at that point. There's, this is at selling at least this amount. It becomes your line in the sand, just like Bill would say that, if something's down 7%, you're going to cut your loss no matter what, because that's a portfolio management tactic, not an individual stock tactic. And that's where, I thought he was right with that 7% max loss, even though how he expressed it, I didn't necessarily agree, because of where we picked the models and all that stuff. But from a risk management standpoint, the smaller your max loss is, the better off you're going to be. You just have to balance things out with the chop that can happen. And that's, so here at this point, like, why would you want to be in this still waiting for that? So it's 6% versus its pivot. But look at that, how bad, that's clearly a broken chart. If it would have to really come all the way back up to here before I'd even consider it. So why do I want to really be in that? So exiting the rest, and of course, you get your 50-day there, to the 21-day, break below both of those. But let's just play this out. So it bounces a little bit, which is normal. Still hasn't hit our 7%. Not on a closing basis, because you can see it up there. Okay. Finally now down 7%. So this is a reason why not waiting that long. Let's look at it on a weekly, and on the weekly, it's clearly, not looking good. It wasn't looking good the week before that. So that was kind of a cookie cutter one. We're going to have some trickier ones. So here's Duolingo. And we're doing this historically. So some of these things I might have a position in as of this recording. So as of 5/31, I do own some of this that I bought yesterday after I put it on Swing Trader, because it got support at the 500, shake out below this little shelf area, and got support at the 21-day. Now, if this goes below there, I'm going to be out of it, but we'll see how it plays out. But I just have, for compliance reasons, I just have to be, say all of that. So obviously we're going to do this cup without handle breakout right there. And with this one, you can see this one never violated that. So here was your day 0, here was your day 1, and you never went below that. So this is how you want them to end up working out. And yeah, so that's a good one. So no more on that one. Let's do flow serve. Okay, so here is, we're going to go back to January 16th. All right, so again, this is day 1 low, and this is day 0's low. Let's play this out. Okay, looking good. And you've got to put out of your head that that it failed. You can't, you've got to be intellectually honest with yourself and not say, oh, I'd sell it here and just lock it in. No, you wouldn't, unless that's your rule. Because remember, we're not swing trading, we're trying to position trade. Doing nothing abnormal, nothing abnormal, nothing abnormal. Well, that's pretty abnormal. All right. So we get a big gap down, close below your 50-day, but more importantly, you get a close below the low of day 1 and the low of day 0. We're only 4% past our pivot at this point, but I would see no reason to hold any at this point. But then again, like I said, that max line, if this was an A quality stock and maybe the market just had some really bad news or something that day, and you want to try to give it some space, keeping that third, until it goes down 7%, you can do that. Now, I know Bill, he would be out of it on that day for sure. So let's go to the next one, and let's just go out and see what ended up playing. So that was that day. And you'll notice a lot of them kind of come back, but they'll have weak rebounds and then they go lower. Then again, this was a bear market. So if we didn't have that bear market, it could have worked itself higher, just being honest. Okay, let's do our next stock. Oh, Fresh Pet. Okay, this is an interesting one. And as an animal. Well, we won't even get into that. Let's just get in to this over here. So on the 5th. Okay, so here was day 1 right there, that low, and here's day 0. So let's go through, and it looks like on the 4th is your first day where you close below. Okay, the low of day 1 is 156.66, close below that. Let's see, day 0 low is 155.82. What do we have? 155.38. Okay, so again, if you're doing the 50-50 method, you could be out of the whole thing. If you're waiting for that last one, for that 7%, which would be right around in there, you can do that. So let's just go out a ways, and you can see that, yes, on this day here, on the 5th, let's go back to the 5th, that triggered your 7% loss. And we'll reset to today. And you can see you definitely want out of there, right? Because that's not a pretty picture. So let's go to the next stock, IoT. Okay, so we're going to focus in on the 20th over here. Hopefully this is making sense. All right, so let's go to the 13th and just walk through this. This, we find out later, is day 0. That is day 1. That's your breakout. So here's our line in the sand. Here's our line in the sand. So we're going to go out. It's looking good. That's normal. Abnormal. Okay. So now you get a close below both of them in intraday. So you would have to sell everything this day, because the one thing that Bill had is that once it's down 7%, you sell the whole thing. You don't wait for the close. So in this, so far, we've been talking about, and I'll circle back to intraday trading it, but we've been focused on the close. And so intraday, this was down more than 8%. It was down about 9%, or maybe even more at the lows of that day. So you would have to be out of it. So as it's going down 7%, you've pulled the plug on the whole thing. But regardless, using the breakout rules, you would have been out. You would have been out of at least 2/3 of it. But as I said, that other thing is an overriding. He would not wait to the end of the day. If it hit his stop intraday, he would be out. And then just look. I mean, wouldn't you rather sell there than, all the people are like, oh, it's a good company and I'm a long-term holder and you trade too much, Mike, and blah, 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 whatever, man. Okay. So here's JD. This is a little bit all over the place, partially because it's an ADR. So, it's foreign stock. So let's go through this and we'll just look over here on like March 12th. Okay, so here's our day 1, and this is our day 0. So on this day here, we've closed, let me just go back to. So on this day here, we have closed below the low of, no, we haven't. Okay, yeah, because this is day 1. Let me go out one more. Okay, so now we've closed below the low of day 1. And did we close below the low of day? Maybe a blanket rule would be like, if you have to squint to look and use the track price to see if it's below it, it's below it enough. Okay, so 40.31 is the low of day 0, and it closed at 40.64, but it did undercut it. So technically, the rules are that you could be holding that, but I would be out of that because it's, there we go. It's down 7% from its pivot. So you have to be out of the whole thing that day anyways. Okay, so we're going to move on to that. Well, let's just reset it to today. And you can see, lots of these bounce back for a little bit and then they roll. That's normal and natural. Go to the next stock, KKR. Okay. Hopefully these are really making sense because these are pretty cookie cutter. I'm trying to stay out of the nuances for now. So here's your day 0, and here's your day 1. And this day here ends up being your first day that you close below um, everything, because you're down 9% from your pivot. So intraday, as it gets down to 7%, you have to sell everything. But on top of that, it closed below both of these. But let's go ahead and talk about this now, that on the reality of I'm going to have to get into the weeds. I'm just trying not to, but okay. There's so much volatility around breakouts and post breakouts that if you wait to the close, it is going to help you a lot, but it's also when it falls apart, like that other, like what we saw out a couple more days, that you could really be getting out late. So what you could do is kind of split the difference. So we were originally saying it was a third and a third, a, a third, a third, and a third. So a third at the close below the low of day 1, a third at the, the low of day 0, and the last third at 7%. But what you could do is break that up even finer. And I will tell you, there are times where I will put like 15 different stop losses in on a position, because picking one, I know it sounds overkill and I don't do it that way all the time, but if you've got a big position, but you also don't want to give a lock back at off the top, if there's levels that make sense, whether they're ATRs, percents, things on the chart, intraday levels, what have you, just having different stops along the way. It's better to have sold some if it comes back and roars higher than to have sold the whole thing. But it's also better to have sold some at good prices if it collapses. So you've got to find what meshes with your personality. How much time do you have? And so what I would suggest is contemplating is having us intraday stop at the low of day 1 and the low of day 0 for a portion of it, because then that way, if you had a stop here and a stop here on some of those, as it's going through there, some of those shares are going to be sold. So now it just really depends on how much of that you want to do. So to just keep it simple, what you could say is, okay, just take the number of levels that you have and then, divide that, right? So you've got your 7%. So that's 1. You've got the low of day 1. You've got the low of day 0. So that's 3 different things. So before we divide it into 3, and those were on a closing basis, right? Or the first 2 on a closing basis. The 7% is intraday. So now what we could say is, okay, we're going to put a low. We're going to put something at the low of day 1 and day 0 on an intraday basis. So now you have 5 different things. So an intraday basis on day 1 and day 0, a close on day 1 and day 0, and your 7%. So now you have 5. So you can divide it by 5 and sell, what would that be? 20% each. Now you can also do something that says that, well, I don't want to complicate it, but I'll just tell you, another way to look at it would be, say, once it gets up, X amount past its pivot, let's call it, yeah, I would do it in ATRs, but, let's call it just 3% past the pivot. That then if it comes back into the pivot on a closing basis and closes underneath that would be another one. So then you would be dividing it by 6. And you could also say, well, even on an intraday basis, once it gets up 5 or 6%, you don't want it to come into the pivot at all without selling some there. So you could do it, then now you've got 7 ways to divide it. So, and it can get even more complicated than that. So lots of you probably don't have the time for that. So we're going to, for the rest of this, break it up into 5. Just so again, those 5 were 7%. Stop loss is 1. A close below the low of day 0 is another one. Close below the low of day 1 is another one. So that's 3. And an intraday break of day 1 or day 0 is going to be 4 and 5. So we're just going to divide those by 5, and we're going to sell 20% at a time. So let's just see how that ends up playing out. So with this particular case, you would have sold on this day, because it appears that both of those you would have sold 40, right? Because two of those slots, because it went below this and it went below that. So now you're out of 40% of that. Then okay, so now at this point, this is where at 7%, which is right there, that's where you would be selling the rest of it intraday. So you've at least sold 40% of it here on this day. Now, where is it tricky? Then what's tricky is buying it. Would you buy it back here? And you know what? I might, because I buy things back um, all the time when they. Let's just go back. Let's see. Okay, on this day, that looks pretty good to me, man. And just being honest, that RS line looks good. I'd buy my shares back. But a lot of people aren't going to feel comfortable with that. And this isn't a must buy it back. Just saying I would buy it back. Just knowing me, as long as I thought this was a B quality stock or higher. So let's look at a few more examples. Well, let's see how this played out. And, that would have been a good sell. Let's see what our next stock is. Lulu. Okay, so this is a sloppy base up here, but let's just go through this and we'll go out to here, 2.7. So day 1, day 0. Intraday breach of day 1 here, so you sold 20%. Intraday breach of day 0 here, you sell 20%. Plus it closed below the low of day 1 there. So let's just go to that day. Okay, so on this day, you can see that here was day 1, here was day 0. So it traded below that. Or here, let's just walk through, because it's very obvious to me, but I know that this is new for some of you, so I can go a little slower. So here was day 1. The low was 413.51. Here's day 2, and our low is 412. So it obviously undercut the low of this. And on an intraday basis, we would have had a stop order there for 20%. So now we've sold 20% of our position, and we're going to go forward a day. Now we sell another 20% because we've closed below there, and another 20% because intraday it was below there. So now we've sold 1, 2, 3. So we've sold 60% of the position already. And see what ends up happening. Okay, so now on this day, we've sold another 20% because it's closed below the low of day 0. And it's 5% from our stop, so we don't have to sell the rest until there. Intraday, it would have been down 7%, so we would have sold the rest. So again, sold 20% here, 40% here, 20% here, and the last 20% there. Does this make sense? I can't hear you. You shouldn't mumble like that. I'm the one with the vocal cord problem. You're not even talking to me. You just think I'm crazy for talking to myself. I'm a little crazy. Yeah. Let's see. Just got to keep these fun. I mean, when you're sitting talking to yourself all day, doing these things, it is a little weird. Okay, let's go through Norwegian. I do like their cruise lines, but this stock is not acting right. So 210. I think we did Norwegian when we went to Alaska, and that was fun. That was a really fun one. Let's see. So here's day 1. So then that means that's day 0. So when you got a day 0 that's down there underneath, and that's why I wanted to put this one in here. If your day 0 is underneath your the low of, let me say this again. If day 1 or day 0 is underneath your max loss, which in this case is 7%. Remember, your max loss is your max loss. So day 0 does not come into play here because that's underneath this 7%, because you can see the gray shaded area. Like I said, I believe I set it to 5 to 8% stop loss. So we know that 7% is like right there. So we're not even going to do day 0, but we are going to do day 1. So here, day 1, and then you sell the whole thing on this day. So that's problematic, right? So we're seeing our first big issue with this is when you have these big moves up. Let's go on that day. So it's up 7% on this stock. And let's see, what is the, well, right now it's got a 4%, 3.93 percent ATR, but still you would know that at this point, right, at this point, it's starting to look like those other ones that we saw. So now that's a can of worms, right? Because on this day here, it's down 6%. And did it even close below the low of day 1, low of 26.45? And we've got 26.48. So technically it hasn't triggered any of our sell signals, but in spirit it has, right? Because you would look at this and just say, okay, this is an abnormally strong big up day. So one of the things that you can do if you're not using ATRs is you can kind of, I don't want to send you down a wrong rabbit hole. It's going to take us 3 hours to explain. So let's just say you're looking at logical levels on the chart there, knowing that your risk is greater, that you go into this. And the good thing is on at this point, 128, you're not surprised that your low of day 0 is so close to 7%. So now you're sitting there going, okay, in spirit, where do I want to break these up if I know that my target goal is going to be 3.5%? So you're going to at least do some of it at 3.5%. Let's just make it as simple as possible. I don't think that's the best way to do it, but for simplicity, 3.5%, which is, obviously half of that 7%, that you would sell half of it there and then use the other stuff for the rest of your guides. So let's just go forward. I'll have to do a second one because I really don't like putting that. That's just so squishy. I don't like putting squishy stuff out there. So we'll have to circle back and do more of the tricky things on there. So on the 11th, that's where it triggered everything, right? So now you're down 7%. And you're also closed underneath the low of day 0. So there's no arguing there. Intraday would have triggered the 7%. So you would have just sold it all based on that. So it's nice to know that you at least have that floor of the 7%. Let's see how that played out. And that was right here. And we see what happened. Let's do a couple more. All right, what was I doing with this one? Was it an old base? Why isn't pattern rec pulling up? Okay, there it is. Okay, so here, this was that same basic concept as I put this in here to show how sometimes it's tricky when you have a gap up, because in part of the concept is the gap. That's not really your low. Your true low is the close from the day before. You just don't see that bar there. But with a gap, in most cases, you want to just use the low of that. So here on this day 2, let's go to the 28th of February. You did undercut the low of day 1 for a little bit. So you would have sold 20% there. So we already sold when it undercut that. So we don't need to sell another 20% there because we already triggered that rule. It didn't reset. But here on this one, now we get a close below the low of day 1. So then that would be another 20%. So now we've sold 40% and we're 6% down. Now, the reality is if you're using judgment, you're selling the whole thing here because you're only 1% away from that 7%, and it might have even triggered it on an intraday basis. So I would sell the whole thing here. But if you want to hold on as an A quality stock, you want to give it some more room, you have to at least have sold, 40% of it if you're following these rules, which you don't have to follow. And now on this day, you would have had to sell the rest, right? Because even though it closed down 7%, it was down more than that intraday. So you would have sold all of them. And of course, day zero is way down here. So day zero is just not in play there. And so that was over here. And now it's came back up and tried to break out again. And then over here, that would have been where you would have had to sell the whole thing. Let's do our next stock. Okay, so we've got NVIDIA. Which NVIDIA do we want to do? Well, let's do an old NVIDIA. Let's just go back a year and see if we find anything. Okay, let's do in that base. Let's do in 23. That was December, right? Okay, so we've got this double bottom. Here's day one. Let's go the 9th. Okay, so here's our day one. Here's our day zero. And let me blow this up a little more. Day one, day zero. Kid's birthday. Best day of the year. Let's see. All is good. All is good. It's looking good. It's just got a whole week. Okay. So now still hasn't gone underneath there, but now remember what I said about the coming back into the pivot. So one of the things that you could do is because it's up enough, it was up more than 5%, because this area, blue shaded area, is the 5% from pivot. So it got above 5% there. You could implement that rule that if it came back into the pivot, you'd sell a third. Did it get there? Didn't quite get there. Let's go out. But not a third, but at least a fraction of it, because then you would divide it by 6, and then so whatever that is. So let's see, did our low get there? Low was 474. So yeah, if you were using that rule there, you could sell some of it there. Okay, so now on this day, you are going to sell because the day one breakout low for 467.50 and 460. They made that tricky. It did go underneath it intraday. So at least with the rules that we are using, if we weren't using the pivot rule, which I would suggest using, but if you weren't, then you would sell 20% here because intraday it did undercut the low of day one. Now let's go out another day. Okay. Okay, now we've got a close below the low of day one and intraday below the low of day zero. And let's see, what is the 459.68 and 455. Okay, so we've got quite a few, right? Because we sold some here, 20%, because well, no, we're not doing that thing. We sold some here because it went intraday below the low of day one. Then we're selling another 20% here because of it closed below the low of day one. We're also selling another 20% because it closed below the low of day zero, and intraday another one because it was intraday underneath that. So we've sold 80%, right? So now we have just 20% left. And let's see. And about a week. Never triggered the 7%. Guess it's a multiple stock. How deep was that? So it was 11% deep. base and about to the end. So you still had 20% in there that you survived with. That would have been hard to survive with, but frankly, you could have added some back there, and certainly added big there, right? Because that's a full new breakout. So you'd have a new position there, full position, plus your 20% that you were still holding on to. So bigger than average, and it never went back. So this is how a breakout is supposed to work, right? It never goes back in there. Hopefully that made sense. Let's go back to current day. And let's do the next stock, Owl. Okay, hopefully this is all making sense here. 2-7 should be all we really need to look at. Okay, day 1, day 0. And day 1 here, a breach on an intraday basis. So basically everything is pretty much sold here. A breach of intraday below the low of day 1, below the low of day 0. So that's selling 20 and 20. So that's 40. Close below both of them, another 20 and 20. So a total of 80. And it doesn't look like it went down 7%, just 6%. So if that didn't trigger 7% intraday, let's go out another day. And that one probably did. Let's just do the math on here. Pivot was 25 times 0.93. It's 23 and a quarter. How low did it get here? 20, 23. No, not quite. It's just a nickel away. 23. Okay. So on this day, then you're selling that last 20%. And let's just go out to current. So hopefully this makes sense. Let's see, we got a few more. So here's, man, I messed this up. I don't think I bought it. Or if I bought it, I just didn't stick with it. So here's day 1. So we're going to go out a day. So here, intraday, you went below it. So that's the low, went below both of them. So you actually would have sold 40% intraday there. Now, this is an important concept. It comes back and you can certainly buy it back, but realistically, you know what? This day, at the high of that day, I would have been buying it back because it was clearly, recovering. Now it's stalled by the end of the day. Let's go out a week. And certainly by this day, that big up day, because it's going over the high of that day, that if you didn't buy it there, or if you bought some and then you sold those shares that you bought back later that day, which frankly I probably would with a close like that, that you're buying it back there. So one thing that Bill taught me was, let me just stop sharing for a second. So one of the important concepts that he taught me is that if you're shaken out of a position, that you want to buy those shares back if it sets up properly. Properly is the key, is the tricky part there, because that's squishy, right? But let's table that and just say that we can all agree on what proper is, that you would buy those shares back plus some. This is very important, probably the most important concept of today's thing. Again, you're shaken out of a position. The assumption it's a quality stock. So we're talking an A or a B plus quality stock, not a just run of the mill piece of junk. So a good quality stock, legitimate, shakes you out, buy it back plus some. So that sum could be just 1% more. Let's say you bought 100 shares originally. When you go back to buy it, you buy at least 101. As a general rule, my guideline is 10% more. So if I bought 100 shares or 1,000 shares, 100,000 shares, whatever the amount is, just 10% more. You buy 10 shares, you buy one more share. So you buy 11 shares. You buy 100 shares, come back and you buy between 101 to 110, or you don't buy it at all. And I've thought about this a lot when he told me, and I don't think he realized it. Sometimes he would just be talking and, he would be probably ragging on me. Why didn't you buy that back? You need to buy back, but some gold would come out of those. I would consider those his rambles when he would just not be, he never sat around to teach me anything. It would just be more things that I would pick up. And so that buying back plus some, what it does is it puts you on the offense. So if you're going to go back in, let's say you're shaken out of something and you do it old school, you just let it go all the way down 7%. You buy it at $100, goes down to $93, you sell it, the whole thing, now it comes back up to $101, and you buy it back, and you, instead of the 100 shares you originally bought, you only buy 10 shares because you're like, oh, you're going to play the who, won't get fooled again. I'm not going to let that happen to me again. So you just buy a little bit, and then it goes way up. Well, and then it goes up to $200, and you only have this 10 shares instead of your original 100 shares. What is that going to do to your psychology? And everything in the market, you're trying to protect your psychology, because this is all about psychology. We just have these rules on here just to protect yourself from yourself. It's about psychology. You need to, and I said this in my last one, need to have the proper level of confidence. You don't want to be overconfident for whatever your skill level is, but you want to have the proper confidence. And there are going to be times where you're just kicking butt in the market, and times where you cannot do one thing right to save your life. And I've been in both. And when you're super high and you're doing great, you want to realize that, a lot of that is you, but a lot of that is the market, and the same thing, when you're doing really poorly, some of that is luck, and some of it's market, and some of it's what you're doing. So you don't want to be too thinking you're great when you might not be, or terrible when you might not be. You're probably somewhere, in between. And so confidence is such a critical thing. And I can tell you, when I've lost my confidence, I just can't trade at all. And it's very rare that, I don't think I've ever been overconfident. Yeah. Not for long. If I'm ever overconfident, it doesn't happen for long, because I think I've just seen so many things. If I was ever overconfident, that would have been in 97, 98, which is kind of funny, because it's when the least you don't know. I always say, like, a veteran trader will know that the stove is hot. So sometimes you see some people that are just kicking butt, and they're brand new traders or whatever, and they've got their little service out there, picking stocks because they had a great year, and they all mean well, right? But they haven't been around the block, and they don't know the dangers that are there. Like, Bill was always paranoid about 1987 happening, even though there's very frequent times where the market really crashes, right? We got the COVID crash. We had what just happened recently, that some people don't even realize that was a crash. We had the flash crash, 15 years ago or so. We had, 1987, we had 1929. And of course, you got big bear markets like 1973, 74, 2002, or 07, 09, but those aren't really crashes. He was always concerned with crashes, and fixated of not being in during a crash, because he wasn't in 87. And anyways, I think that's the proper way. That's why he never blew up. Anytime that I've gotten seriously hurt, it's been, mistakes of maybe denial, or over trading, or just not recognizing that I'm off or whatever, and getting smaller. When you're off, you need to get smaller and smaller, position size. That's a whole topic for several podcasts, frankly. But anyways, the oh God, I don't want to. Let's go back to sharing, because I could keep going off on this tangent. You know how I get. So, anyways, it's you're buying back. Well, I didn't. I do need to make sure I finish that. When you're buying back, you want to buy back some more, because then if it goes up, let's say it goes way up and you just had your small position, well, then you're going to be going, oh, well, I'm not going to get shaken out next time. And then you're likely to hold it all the way until it's down 7 or 8%. And we're seeing that, that's just not a good way to operate. And it's not how he operated either, letting it go all the way down to 7 or 8%. So that's why you want to have some rules in between. Now, you could simply have a rule saying, okay, when it's down 1%, I'm going to sell some, down 2%, I'm going to sell some more, down 3%, down 4%, down. There's nothing wrong with that. Dude, use that, use something. Or it's down half an ATR, I'm going to sell some. It's down 3/4 of an ATR, I'm going to sell some. It's down a full ATR, I'm going to sell some more, or sell the whole thing. That's more like what I do these days, frankly. But this technique is quite a bit easier to visualize. You know, the ATR, you need to know what the ATR was at the time, and it's a whole can of worms. But that's really more how I operate. But this is how I operated for a long time, and I still, every time I look at the chart, this is what I see in those, or my guidelines for things. And I kind of use a combination of ATRs and the strategy. But the upside to buying some back, when you, let's say it was $100 at the pivot, and down to 93, you sold it, now it came back up to 101, and instead of buying back that 10 shares, you bought back 110 shares. So now you're playing offense. Now when that stock goes up and it gives you entry points, now you can manage that position properly because you have a real position in there instead of this tiny little baby position, which there are advantages to having baby positions. I do that too, but that's another topic for, see, I'm doing better about not going on tangents. I'm not going to talk about that today. Yes, I'm not going to. And so anyways, it goes way up. One, you can manage that position along the way, but two, it also reinforces to buy the stock back, you know, and buy the stock back properly. So I always go back in and I'll buy it a little bit more. And boy, he taught me that, man, over 2 decades ago, and something ever since he said that in I don't think it was a pleasant conversation. I don't think he was trying to help me out. I think it was more like, you messed this up. But that's fine, man, because everyone teaches in different ways. That's kind of how he would teach. And I'm grateful for it because that was a lesson that really stuck with me. And like I always said, I would listen to every word he said, every single word he said, to anyone or to myself, because it was very important. Just be like, if Livermore was around, you'd want to, you know, listen to what he'd say. Doesn't mean that everything he said was right or good, but sometimes there would be some gold in there, and I thought that was gold. So anyways, hopefully that made sense to you. Let's go back and go through a couple more of these and then call it a day, because I've got some to-do list stuff to take care of, plus work. Let's see what ended up happening. Let's reset it to today. So again, if you were shaken out of it, you know, buying it back, because, you know, that's down quite a bit. That's, you know, down on a percentage basis, almost 7%. So if you were shaken out of the whole thing, you'd want to buy it back. Let's say you were shaken out of the whole thing. I'd buy that whole thing back here plus a little bit. And that would have been a hard buy, but this was a good looking base. And I just mess it up because, you know, sometimes, all the time, you just make mistakes. So here's, generally make 51.5 mistakes a day on a good day. Okay, so here's another double bottom. Well, we can see it here. Here's day one, right? Let's go over to this one. What stock is this? Resmed. Okay. 10, 8. Okay, so we had our day one and our day 0, and now we close below the low of day one, plus we intraday were below it. So even though we're only 3% from our pivot, we are going to sell 40% of it. Now, because of the gap up, it's really hard to use the low of this because that's at 7%. So now this is where it's not always really easy, but at least you've sold and you can use your judgment at this point. But at least we have that line in the sand. If it comes down to 7%, that we've got to sell the rest of that. But you've sold 40% already. And see, I've already purged what the stock did. Okay, so on this day, it's down 8%. So intraday, you would have had to sell the rest of it. And frankly, you know, just being honest, if you would have sat through that because it was getting support at the 50-day, on this day here, the day before, and this isn't hindsight BS, which would really drive me crazy, is this is not how a stock breaks out. That's not strength. It's sitting living underneath the old pivot in a weak position. And then when it tried to go, that it couldn't hold. Now, the day before, this day on the 11th, it's not really doing anything wrong. It looks like it essentially an inside day, but now on the 12th, that's, very weak action. So you don't have to wait for this, but at minimum, that's your worst case scenario. All right, let's go to then we were also going to do, so on this day, that would be the day out of this breakout that it triggers all of them, right? So you have to sell all of them. It looks like that's going to be down more than 7%. This one, let's go to this day, January 27th. So day 0, day 1, intraday breach of day 1, sell 20%. Intraday breach of day 0, sell 20%. Close below both of them, sell another 20 and 20%. So now we've sold 80%. And let's go out a day. So we only have 20% left. We're waiting. Okay, no, doesn't quite get there yet. 6%. Okay, so intraday down here, that would have been 7%, and we would have sold that. So let's see what ended up happening. So where was that? That was this day. So that worked out. Let's do take 2. Oh, this was one of my favorites for a little bit, but didn't work out. Let's go to this day, March 31st. All right, so day 1 is this weird day. It's already failing, right? And here's day 0. So on this day, we'll go back a day, on the 28th, that actually undercut both of them and closed below both of them. So you would be out of 80% of your position at that point. And let's go out another week. And you can see that on this day, you would, let's just go back to it. What day is that? 31st. No, it's already there. Okay. So yeah, on this day, intraday, you would have had to sell the rest of it when it breached down 7%. Even though it closed only down 5% from its pivot, intraday it was down more than that. So again, you use Bill's concept there of when it hits it, you just sell it. Now, I know some people like to wait for the close of the day. My buddy Chuck would do that. And you know what? The vast majority of the time, that would pay off for him. Every once in a while, it would hurt him. But he has that personality to be able to sit with those losses in a way that I just don't, frankly. Okay, so day 1, day 0. So this day here, a breach of day 1 low plus a close below day 1 low. So then that is, look, it's 17% from its pivot already. So that would be, so let me just go back a little bit to where it shows up. Okay, so on this day, it was so wild that, wow. Well, this day you would have had to sell the whole thing because it's down 7% from the pivot. So if that's your day 1 and that's your day 0, so down 7%. Now, one could argue that, look at it as a double bottom and say this is a day 1 and this is a day 0. So let's just do that. Let's just say that that's how you're looking at it. So now, at least on this day, right, because you bought it on this day as it was going through 2608, day 1, you had an intraday breach of it, so you sell 20%. Okay, so now the day 1 low, you've now closed below it, so now you have to sell another 20% plus, let me see, 26.08 times 0.93, so 24 and a quarter essentially. So 24 and a quarter, where did it close? Okay, so it closed underneath that. So you would have had to sell your whole thing because you would have been down 7% anyway. So we had sold some here. But so you want to keep this in mind when you're dealing with these really volatile stocks like this. Not to say to not trade them, but when you're trading them, your position size, realizing that on your exit, you could be really taking a bath. That's why you want to, maybe adjust your position size or raise some cash in your account to be able to manage the volatility. Let's see, how many more do we have? Because I'm getting hungry. This is our last one. That worked. Well, I guess I should have known. It's a V, and we're doing this in alpha. So let's go over here to December 19th. Okay, day one, day zero. So a breach of day one intraday. So we've sold 20%. Okay, so on this day you sell it all, right? Because it triggers the 7%, but even so, it had undercut the low of day zero, and we got to close below the low of day one. So, but that 7% intraday trumps everything. But with that said, really, this downside reversal here on the 18th, what we're talking about with this is our worst case scenario stop loss, not necessarily where you have to let all of them go into. It's just you want to know where your final lines in the sand are. With a big downside reversal like that after a breakout, I'm going to probably be selling. I might sell my entire position there, and just be willing to buy it back if it sets back up. But you don't have to let them come all the way in this far. So I'm hoping that, let me stop sharing here. I'm hoping that this made sense. It was really, man, I thought I was going to get this done in a half an hour, but I didn't. So, is there anything else to add on that? Well, there is a lot, but we'll have to, we're going to be doing plenty of these. We're going to do these in, we'll circle back to the same concepts and review them, even if there's not a natural part two, to just look at more examples and things, because I think that would be helpful. But so in a nutshell, on the most basic level, what we're doing is we're saying that our breakout day is day one. The day before the breakout is day zero. We're going to sell, on the simplest, we're going to sell in thirds. A third with a close below the low of day one, the third, your breakout day. Sell a third at the close below day zero, and then your remaining third, or everything, if it breaches 7% intraday, out it goes. And the reason why he did that intraday thing and not waiting till the close is because even though lots of them in the examples we saw, they bounce back later in the day, there is that possibility of when they blow apart and they're down 30% for the day. And I've been in stocks like that, man. And if you waited until the close, then you really get your head handed to you, because if it's down 7% and you're like, oh, I'll wait to the close, I know how this game works, and you don't do anything, then when it's down 10%, what do you do? Now down 15%, what do you do? Now it's 2 hours to the close and it's down 20%. Oh, but I'm waiting for the close. Well, that's not a great way of doing things. So one other alternative that you can do is do a TWAP, which is, I do these all the time, a time-weighted average price. Now, a lot of brokers don't offer them. I trade through a couple brokers. One of them is Interactive Broker. They don't pay me anything. I pay commissions for the use of their algos. And I love them, man. They've got percent of volume. They've got all sorts of algos, but the algo that I like the best for your orders is a time-weighted average price. So let's say it breaches that 7% or whatever line you have, it breaches it. You can do a TWAP selling that to the close, or for an hour, for 15 minutes, for 10 minutes, whatever time frame you want. You could sell it to the close. And then if that starts getting really out of hand, let's say it goes from 7% versus the pivot or cost basis down to like 10%, and you're like, oh, well, that's enough. Then you can cancel that TWAP and just go to market order. And you could also do that as it's coming down, like maybe it's down only 3% from its pivot. You could start that TWAP to the close, on those shares. It doesn't have to be an all or nothing. And if your broker, let's say you like your broker and you don't want to, switch brokers to one that offers a TWAP, you can just do it yourself. Now the commissions are free. You can take your shares and just break it up into, small things and do your own TWAP. So that's, those should it just depends on how much work you want to put into it. If you're, a weekend warrior type of trader, there's nothing wrong with that. And you just want to put stop orders in so you can go to work during the day, man, I totally get that, man. I was in that world. And, stop orders really will save you a lot of grief. Me sitting looking at these screens all day, man, you make a lot of mistakes, emotional mistakes, because you see, oh, the market's ripping. You want to increase positions. Oh, the market's falling apart on this news. You want to decrease. And if you're just stepping back and looking at things at the end of the day and you put all your orders in and you've got stop orders in on everything, man, I think I'd trade better if I did it that way. That's how I used to do it in the 90s. Because I couldn't watch the market during the day. They wouldn't let me. And that's a topic for another day. But anyways, so just use this. Don't feel like this is set in stone. I mean, there's variations on all of this. Use this as guidelines, or Webby's rules and guidelines on breakout failures, on cutting your losses. And if you come up with something better, more power to you. Like I said, I use ATRs as a lot of my things. If it's down more than half of an ATR, I'm doing some reductions, 3/4 of an ATR or full ATR, typically out in most cases. But that's more from a swing trading standpoint. And what we were talking about today was position trading. So hopefully this was helpful. I'm going to now switch gears, and this is going to be a pretty special musical thing. And if this is your first one, at the end of each one of these, I switch gears and talk music. Sometimes I will bring back up a trading concept. Most of the time I don't. So if you're not into music, then no worries. You can go on with your day. Again, for all of these, I would suggest when I'm just babbling on, listen to 1.5 times speed or higher. It makes it just easier to get through things. So we are going to talk about someone very special, Kenny Wayne Shepherd, right there, and it's also right here. And those probably don't know who he is unless you're a blues fan. And he was back in must have been the late 90s. He was a young kid, and he came out with, at the same time, Johnny Lang came out. I'm a big fan of both of them. And there was a time where it was like, oh, you can only like Johnny or you could like Kenny. And that's just silly, man. It's not like Sammy and Dave. It is, they're both great, really great musicians. And, as it turns out, Kenny's got a great voice. Now he's been singing on the last several CDs, but originally he had singers. But anyways, the reason why it's so special is, and there's a reason why both of these guys are next to each other on there. And I used to have them on my wall over there, but when I painted the office, I took everything down and I just put those back up there. And man, this might get me in some hot water, but I've got to do it. You've got to stand up for what's right in the world. And he got canceled a few years ago. And let me show you who he is first, and then we'll talk about the cancel. So it always takes me a second to get the thing set up. Okay, so this is Kenny Wayne Shepherd. Obviously, I always use Spotify. That's his new album there that he just put out with Bobby Rush. The one song, if you know any of his songs, you probably have heard Blue on Black. It's a great tune. I don't think it's his best song, but it's certainly a great song. One of his best is probably Deja Voodoo, which is this one here, one of my favorites. But we're going to go into the albums here. In the album we are going to talk about is going to be this album. So he came out in '95 with these three, in the '90s, and then took a little bit of a break, and then he did this one. This one was quite different. We'll talk about that another time. But then he did this 10 Days Out on the Blues Backroads. And let me just kind of click on that so you get a sense for what this is, because this is actually becomes very important. So all these he did with other people, and you've got BB King in here doing A Thrill Is Gone with them, and a bunch of people that you've probably never heard of. Look at these, like Cody Stark and Etta Baker and Henry Townsend and John D. Holman, and some of these people you would know, or there's Brian Lee and Buddy Flat, and just there was Pine Top was in there that you probably know, and a few of them that you might have, if you're a blues person, you would know. But I'm going to just stop sharing here for a second, because this is actually very important. He got canceled, and I have this on DVD. I pulled this out, that same album, on DVD, and you can get it. Obviously, I don't even have a DVD player hooked up anymore, but you can get it on streaming on some places. And he spent 10 days and a bunch of his money going out and recording a bunch of old blues artists. And I think all but one of them was happened to be old blues artists who typically are black, and they happen to be black. And one guy, I think, was white. I think it was Brian Lee. But anyways, he did this because he felt that these people weren't going to be around forever, and they were, older in life, and they'd been forgotten about. And the music industry really screwed them, because back in the day, even Muddy Waters, Buddy Guy, BB King, all the ones, Howlin' Wolf, the ones that you would know, those guys got, screwed by their record companies. Their intellectual property was not paid. Something that is near and dear to my heart. And so he just felt that was wrong. And these people, some of them were living in pretty much poverty. And he wanted to go out and have, let them have their day in the sun the way they should have. So he took his, went out with his recording van and or RV, and went out and recorded these people at their places. And then he went and did a tour, a concert tour, with as many of them that were still alive, because they started, slowly passing away, or they weren't able to travel at their age. And I did actually go to that tour, and I had an extra ticket. I would typically go to concerts with my son, but he wasn't old enough at that point. And so I went with Charles Harris, and we went, and I don't think Charles liked that concert at all, because it was just like old blues tunes. And he's like, they all sound the same. And I get that. Like, I would think that too if I wasn't a blues fan. But this is the album that we're talking about, because he did that. How many other people do you see going out there, and actually seeing that there's a problem? And the problem was that these old, just call it what it is, these old black artists were taken advantage of by sometimes by black people, sometimes by white people, but by people. And that's how I look at people. It's not by color, but by people, what type of person they are. And, when someone takes advantage of someone's intellectual property, it's not cool, right? And so they were never taken care of, and he was trying to help them out. Now, fast forward, and I just thought it was a beautiful thing and a wonderful thing. And he was, good friends with BB King, and BB King kind of took him under his wing early on, which is something that he would, tend to do. And, he got to meet Stevie Ray, which is in the middle there, if you haven't picked up on that, early on, because his Kenny's father was in the business. And I think he was either a music promoter or a radio show host, or both. And so he got to go backstage and see Stevie, early on, and everything, and they have when he was just a little kid, and it had a big impact on him. So now fast forward just a couple years ago, his father is on the Blues Foundation board, and he gets nominated for maybe this was 22 or 23, gets nominated for one of their awards. Now, the woman who was the president at the time of this Blues Foundation organization happens to be a relative. I think it was the daughter of Muddy Waters, and I don't think she was an artist, but saw that he had a car that she didn't approve of in his car collection, because he has a bunch of muscle cars. Like if you see him, he's got his cars in like muscle car magazines and stuff. He collects old ones. Not my type of thing, but that's what he's into. And he collected this one car that she really found offensive. And frankly, everyone in this day and age would find it offensive. But and I'll get into that in a second. So she decided, without like reaching out to him and talking to him or anything, in seeing about this, she just canceled him. She had his father removed from the board and got him off of that thing, which really could have killed his career. But it didn't. But she did, and that's not a cool thing to do, like if in my book. And so I went on Twitter and I was just like on a rampage about it. And so that's why I bought both of these and I kept them next to each other, because now I'll explain what that car was that was so offensive. That it was the General Lee from the show The Dukes of Hazzard. Now, I'm 53 years old and he's a bit younger than me, but not too much younger than me. And so people that grew up during that time frame, there were car shows. There were really three car shows on TV. There was Knight Rider, which had Kit. There was the A-Team that had that black and red van, and then you had the General Lee. Oh, and then you had Magnum PI with the Ferrari. And every boy, and probably some girls, but every boy my age, we all obsess. Oh, which one's your favorite? Do you like General Lee more than Kid, or do you like this? Like it was a big deal. Like, that's like just boys being. You're not thinking that like on top of it, what was offensive is General Lee, Robert E. Lee, who was the head of the Confederates Army during the Civil War. That was just painted on it because this was a show about people in the South, and those were the people that fought on that side, and then the people in the North fought on the other. If you're not up on that stuff, and anyways, it's a very offensive flag in this day and age. But you got to remember, back in 2005, the Warner Brothers put out a redo movie of Dukes of Hazzard. So just 20 years ago, about the same time that he bought that car that became so offensive to Muddy Waters' daughter that she would try to cancel his career, that he bought that car around that time, is my understanding of it. And that's when the movie industry still put this out, and they didn't put a different flag on there. They put the same flag that was always there. And it was, times change and people become sensitive to different, just as like words change. Like you could say, certain word back in the day, then it is deemed offensive, then it changes to another word and another word. And, I just realized it's kind of like how old you are, because I would always have to correct Bill on things he would say that he didn't mean any negative offense, but I would tell him, like, Bill, you can't use that word anymore. You've got to use this word. And it didn't click with him because you get so set in your ways, But you've got to think of people's intent. I mean, there are bad people out there. There are racists of all colors, right? There are people that are against different religions. There are people against people who are too short, too tall, too fat, too skinny, too whatever, everything, But think of, like what Martin Luther King taught us, look at the content of your character, not the color of your skin. And Buddy Guy has a really good album out that is called Skin Deep. And when my kids were little, we used to sing that in the song. All three of us would, and it was about how we're all created the same, And so I don't think of color, I don't think of color even the slightest. I was just brought up to just not even recognize that someone's a different race. Like it just didn't, maybe it's because I was brought up on the Marine base and you had everyone. It was just a big melting pot. You had Asians and Hispanics and blacks and whites and anything I'm forgetting, of all descents there. where you're living, and you just don't even you don't even think about it, and so um this really rubbed me the wrong way, that he would get canceled for buying this car that, the point was every kid wanted to have this car. And it wasn't even, when I grew up, part of the, I was born in Virginia, and that's where Robert E. Lee had his house, from memory. In our Cub Scout troop went out and actually went to his, toured his house as part of a normal thing. So there was a different time and place. And think about like Leonard Skinner, they used to have the Confederate flag up behind them. Now when you look at it, you realize, okay, well, what it represents, and you can't do that. Like you just can't have, or Bon Scott from AC/DC used to have a belt buckle with it on, and you just, it's inappropriate, and there's nothing right about it, right? But there was a time and a place. Like there was, whatever we're saying right now, what everyone's comfortable with right now, in 10 years from now, some people aren't going to be comfortable with it, but you have to adjust. But again, the content of someone's character. So how many people do you know that went out and spent their own money? Obviously, he probably took a bath in this to go and help some old Black people that got screwed by probably other Black people as well as other white people, because both were in charge of those, like chess records and things like that. So here's someone who actually tried to do something good, was big buddies with all the people in the blues community, including BB, and then he gets canceled. So I went on a rampage, because you've got to plant your flag somewhere. He's not a racist. He's he's the opposite, and so you just can't say that someone owns something. And actually, what he had done is, once the tide kind of changed and people were focused in on that, he put that car in storage and wouldn't drive it. Like long before all this stuff happened, he recognized that you can't drive it. I was out in Chino visiting my parents last month, and I saw one of those on the road for the first time in my life. A replica of that Dukes of Hazzard General Lee car that was all this controversy. I was surprised that the guy was driving it, frankly, because man, you shouldn't do that, man. But anyways, it's not me to judge. It's not for other people to judge. You just live your own life. But don't try to cancel people. If you try to cancel someone, cancel a bad person. Don't just blanket go out and cancel. I hate this cancel culture BS, man. It just irks me like there's no tomorrow. So that's why I put those two, and I had them up on the wall where you couldn't see. And then I decided, I'm going to put them here. And eventually one day I was going to tell the story. And I'm going to tell the other story about how, let me share this other song that came out. This was really cool. I dug this, that, let me go back out to, see all of his albums. Oh, so here's his new album with Bobby Rush, who happens to be a Black dude. But that's not why he's doing that. But let's just look at the singles. So this nice lady, Shamika Copeland, did this song when this all hit the fan. So I guess this must have been a 2020, because it was in 2021 that this song came out, and you should listen to it. It hit him back, where that was her singing with him playing, and is basically saying, like, well, listen to it and you'll see. And then on it, Robert Randolph, also a Black dude, great. I've seen him a few times, and he plays. Well, we'll get into him. He's a great guitar player, very unique. I saw him open up for Eric Clapton at the Hollywood Bowl once. Man, he put on a great show. But yeah, this was the way that that he came out, and he of course apologized for if it offended anybody, but he didn't mean any offense by just buying this thing that you wanted. Like, just think about what you wanted as a kid, as like a 9-year-old kid. And could you still like that now? Probably. But what if you couldn't like it, or you like it, you're able to buy it now, and 10 years from now it's deemed really inappropriate, and you put it in storage or sell it? Like, did you really do anything wrong? Were your intentions wrong? So anyways, I think it's a wake up call for people to stop just canceling people. Just listen to them, no matter what. Just listen, and you might learn something. You might learn that what you think about the person is not the case, or you might find out that they're way worse than you thought, and they should be canceled. Like, some people should be canceled, but like, hear it out. And so, I'll tell you, there are people out there that have no um, racial things in them, and I'm one of them, and I just credit my parents for it. I could tell you, like, growing up, I like I said, I just didn't see any of that stuff. And I'll just tell this one story that might kind of demonstrate how clueless I was. It was that I was in high school, and it was club day, where the president came up, or the father, must have been Father Cronin, got up, and it was a all boy Catholic high school, and say, hey, this is club day, and you want to go to wherever your interests are. And I didn't know anything about this, and I was so into swimming and other stuff that, like, I didn't really have time for things. But they were trying to broaden your interests, and they said, okay, fine, there's all these clubs here, like, I don't know, 50 clubs or something like that, I don't know, and like a chess club and a tennis club and a this club and a that club. And find what's interesting to you, and try to do something out of your wheelhouse, what something different. So I didn't want to go to like a swim club, because that's what I did, that or water polo. So I was like, oh, okay, what's interesting? And so I went around to all the different booths, and there was this one that was it was like the Black Club or whatever, and Black culture. And I was thinking, okay, well, at the time I was a huge fan of the Cosby Show, like, massive fan. I know that Cosby turned out being not a good person, well, a bad person. If all that's true, like a really bad person, but I didn't know that at the time. No one did. Huge fan of him, fan of Prince, BB, Hendrix. I was thinking through, I'm like, all the people that I like, the vast majority of them are Black. Everything I'm into, I was into Eddie Murphy, I'm like, oh, well, there's this black club. I guess I'll go there. Not realizing this white dude shouldn't go there, but I didn't. I was so disconnected from race being an issue. Like, why would you judge someone by the color of their skin? Like, I still I can't compute. Maybe it is my Asperger's or something. Like, I just don't understand how you would judge someone by their actions. So sorry this is long, but yeah, it is what it is. So I did tell you didn't have to listen. So anyways, I go into the club, into the room, they're like, okay, on Tuesday or whatever, it's everyone, all the clubs are meeting, and I go into the club, and I'm the only white dude there, and I'm still not realizing that there's, like, because I'm not seeing the color, I'm not seeing anything. Everyone's like looking at me, and I'm just trying to think, like, like, what's going on with me, and then frankly, they're like, they kicked me out. I was like, I didn't understand. Like, I still, like, didn't understand that I wasn't allowed to be in their club because of the color of my skin. Like, I just did not get it. And and I didn't even think about it really until I was like, oh, okay, I can't be in. Maybe they're full or something. No, like, I just, and it was years later when I look back at it, and I thought, and all my friends were like, I think I was like the only white dude of all the friends. I had a Japanese best friend, another guy was Filipino, another guy was from Haiti, another, I think there was a guy from the Dominican Republic, there was a guy from Puerto Rico. Like, we were all just, it was just no one cared. But anyways, that is just the moral of that is, and I will say this other story about Kenny, and then I'll shut up. The probably one of my favorite nights in my life was when I saw Kenny Wayne Shepherd with my son Eric. And so this was several years after that one, once he was old enough to go. And there was this charity event that Kenny was putting on. Him and I think it was Ted Danson from Cheers, and of course we lost Norm, or George, who played Norm recently. And man, that guy was so great. He just I loved Cheers. But anyways, so there's so many great clips of him on YouTube. You should just watch the Cheers clips with Norm. I mean, I could watch those all day long and still laugh, even at the ones I've heard a million times. But so we go to this charity event, and it's for I believe it was kids with cancer. And they before the concert, in I think this was out in the valley somewhere. Forget where, but anyways, they had this whole casino night, and so it was blackjack, craps, roulette, all these table games, and you couldn't win money, but what you could do is you could win tickets. So it was a way of fundraising. So I bought a bunch of chips, for Eric and I to play, and I didn't play. I just let him play because he had never gambled before, and he was just 10 or 11, something like that. And he won on everything, and he was so happy, and he didn't realize how lucky he was. Like, he was playing blackjack, and I think he hit on like 18 or something like that, and because just let him do what he wanted to do. I'm like, hey, whatever you want to do. And he'd get blackjack, and then he'd win a bunch of this stuff. Then we'd go over to craps, and he would win there. And then we so craps, roulette, blackjack, and and he just won. He won so much. It was just crazy. I was so wishing that it was real money. Like, he could not lose. It did not matter what he did. Like, if he did the right thing or the wrong thing. Obviously, a 10, 11-year-old is not going to know how to play craps or blackjack or any stuff. So I just let him have fun. And he ended up with all these tickets, what were raffle tickets, in the way that then they did a raffle for all these different, prizes. And he won what was the big prize, which was this wine, but it was a case of like expensive wine or something like that. And I'm like, well, this is really for him, not for me. And as much as I would have loved the wine, and, I was like, what, so he has his wonderful night, and I'm going to let him like say, oh yeah, he won it for his father to drink wine. So they did have something, lower down the thing that was like Guitar Hero or a Rock Band, one of those two. The things that you would play, and it was like a game that was like pretend guitar and drums and stuff like that. And so that's what he won. And then he won something else too, and I forget what it was, but it was something that then we turned in to get the lower thing that was something that was appropriate for him. And so that was a wonderful night. But before the show started, I saw Kenny walking through, the place, and I'm like, well, this is my, opportunity to just, I just shook his hand and just said, hi, blah, blah, blah. It's just a pleasure to be here and to meet you. And would you please take a picture with my son? And he was so gracious and kind, and took a picture with him. And I cannot find that picture to save my life, and I don't know where it is. But that was really cool. And then it was general admission, and somehow the two of us there was like little steps before the stage, and we just sat there. And so we were front row center for that concert. And that was just unbelievable, man. What a great guy. So trying to cancel him, man, clearly got underneath my skin because I don't put up with that type of BS, man. So if you want to cancel me for making sticking up for someone who's doing the right thing, then go ahead, man. I don't care. You got to do the right thing in the world, regardless. And so judge people by how they act. Don't judge people by what they look, their age, what gender they are, who they like to sleep with, or any of that stuff. It just, just treat people, good people, bad people. They're everything in between, but it has nothing to do with anything else, in my opinion. Not one to preach, but I guess I just did. So with that said, your job for today, for watching this, is to do something kind. That is your payment. That's what we do here, because we are trying to change the world for the positive. So you need to go and do something kind for someone, at least one thing per episode that you watch. You can do more than that, but do something specific, and really think through, because the more kindness that we put out in the world, the better this world is going to be. So someone could know what you do or don't know. They don't have to know. Do it for a stranger, do it for your spouse, do it for your kids, your parents, or anyone. But just the more good things we do, the better off we'll be. Like I said, going forward, I'm going to try to start doing bringing in some guests and just hanging out and just talking and seeing what comes of it. And so if you have ideas for some people, send them my way. You can either comment on them here, or you can send them to me on Twitter or X. My handle is Webster 1971. And I think that's about it. I probably had some other things to say, but you know what? I got chores to do. So peace out, guys, and I will talk to you soon.